everyone. This is on. Everyone can hear me okay? Wonderful. One of the first things I noticed in the second half of the session is all of the female advisors are bad news bears. We're talking about bad stuff. We're talking about employee fraud and divorce. And Giselle and I are going to spend some time sharing some insights with you on unintended consequences and death and taxes. Who wants to talk about death and taxes? Giselle and I have over 40 years of combined accounting, assurance, and taxation planning advice, and we're really excited to be with you today. I am Rachel, and I am the tax geek. This is Giselle, and she is the accounting nerd. And what is it that we're going to cover with you in our very short time? So we're going to talk a little bit about exiting your business. We're going to talk a little bit about value drivers and how to protect those. And we're also going to talk about traps, the tax traps. What are some of the common things we see with family business owners and how to overcome those?
So I'm not sure if all of you have seen this slide before, but there's basically two ways you're going to exit your business. It's going to be voluntary or involuntary. Now, voluntary means that you've planned for the succession plan. Someone's come and offered you $20 million for your company. You sell it and you're all happy. But what happens with an involuntary sale? And are you ready for an involuntary sale? So basically, there's 4 things that affect your involuntary sale. And I brought some visuals because I'm very visual.
Yes, we have props.
So Joel talked about the wealth of a family. I don't know where Joel is. He's not here anymore. Anyways, if you can imagine that's the family's wealth. And basically, there's 5 Ds that affect your wealth. I had to cut them ahead of time. So the first thing that happens is you get disabled. So you can imagine a family dentist getting disabled, or yourself. I think there was another gentleman that spoke, I think it was Paul, about his dad. Something happened to his father and he had to take over the business. But anyways, if you're disabled and you don't have a disability plan or some kind of succession plan, that can take a chunk of your apple. The next thing that can happen is you die and you forgot to get the will updated. You forgot to look at Rachel's traps and make sure there was cash out of the company so you get the capital gains exemption. You didn't get around to setting up the family trust so you could share the capital gains exemption with everybody. So that took another chunk of your apple. The other thing that can happen is you get in a disagreement with somebody or divorced, as Natalie said. And everybody knows half your apple's gone in divorce. That's a for sure thing. Right, Natalie? So we're just here today to, wake up, protect the apple, and protect yourself against an involuntary sale. So before you do any planning, we also heard about Microsoft shares. Does everybody remember the Microsoft presentation this morning? Do you remember the value of the Microsoft shares? I heard 50, and then I heard 24, and then I heard 57. So as a show of hands, how many people right now in this audience know the value of their business? You've maybe had it valued. And how many people in this audience know the value of their RSPs? Everybody knows. It gets done every month, and you read it. And it's short-term, short-term, short-term. So I'm just going to give you a couple, before Rachel talks about the traps. I love people say, you need insurance. You need a succession plan. But I don't know what my company's worth. So if you don't know what your company's worth, how do you do any planning whatsoever? And most people don't want to pay for a valuation, but there's a lot of valuations that can help you learn what drives the value in your business. Right now, we do short-term decisions. Let's get this new customer. It's going to help our EBITDA. It's going to triple the sales, this new customer. But now, it consumes us. So 5 years from now, 80% of our sales are from one customer. What did you just do to the value of the business? You haven't diversified. Your company might not be worth as much as someone who has, 100 customers at 80% of the business. So let's look at a couple key things. So why is knowing the value important? It's a reality check. You've got to measure it. You want to grow it. It's good for estate planning. And it's good for protecting your assets. Someone else was talking about holding company, getting the money out of the operating company. So I've got a couple more visuals. So just as a show of hands, two companies. One company has $1 million of retained earnings. Another company has $2 million of retained earnings. How many of you think the second company's worth more? How many of you think the first company's worth more? So two companies exactly the same. One has more retained earnings, more cash. Aren't you going to pay more for the one that has more retained earnings? Not necessarily. It depends on how much earnings those retained earnings. But having said that, if you had two companies, these are your retained earnings. So the first thing you have to do when you value a company is look at what you've got in retained earnings, what you've got in assets. The second way to value a company is EBITDA. Everybody knows what EBITDA is? You're earning. So these are visuals, just so you remember. This is the goose that lays the golden eggs. Now you shoot the goose, there's no more eggs. So the question is, how many eggs does the goose lay each year? And the higher the eggs, the more someone's going to pay for your goose. So do you have high retained earnings and a goose that lays a lot of eggs? That's the EBITDA. But there's a third thing that you might not even consider. Is my husband did this last night. Actually, online you can learn how to build one of these. He's got his phone going and he goes,
Does he have plans for you, Giselle?
I don't know. This is the noose for the goose. And this drives the value. One customer, 100% of your sales, that noose is pretty tight. If I'm going to buy your business, God, that customer could walk out and you've got nothing to sell. So a lot of valuators will look at the noose on your company and say, you know what, you got one key guy, he knows all the customers, there's a lot of risk, you're only going to get a multiple of 3 or 4 instead of 10, which you'd like to get. So why am I telling you this? This is some numbers, because us accountants love numbers. But just the EBITDA, $2 million, goodwill, $2 million, because the risk multiple is one customer. But there's a lot of retained earnings, so the person's going to maybe buy your cash, your receivables, your payables. So the total value is $6 million. But in this company, EBITDA is the same, but now the risk factor is 5. Multiple of 5, because you have lots of customers, lots of suppliers, a huge business. And you can see that that company is worth $14 million. So the noose on the goose is very important for valuing your business. And every year you make a decision on driving the EBITDA and getting the goose to produce more eggs, you might be tightening the noose on the goose. So you have to be thinking about your value when you make some business decisions. And I thought it was perfect about the Microsoft. We are still short-term planners, even in our business. We're not looking 5 to 10 years out. So this slideshow will go around to everybody, and I just did a little calculation, and you should be doing that calculation year after year to see that you're growing the value. Now, you have to decide what the multiple is and what your risk is. So how do you reduce risk and protect the value? Diversify, diversify, diversify. New products, new customers, new markets. Organize and fix the traps that Rachel's going to talk about, and be a constant innovation, because we know what happened to Uber. The value of the cab company's businesses dropped in 1 year. So I'm going to pass it over to Rachel.
I'm going to talk a little bit about traps. These are some of the things that we find a lot of our family business owners walking themselves into, and what ends up happening is they keep less of their own hard-earned dollars in their pockets because they're giving it away to the tax man. And we do not want people giving anything more than they need to the tax man. Things like owning too much of your business, paying too much tax in the growth and exit phases, thinking that your company is clean, not having adequate or life insurance in the right spots, your wills, bad shareholder agreements or no shareholder agreements, and thinking you have lots of time for succession planning. So we'll spend just a couple seconds on each one because we've got, I think, about 10 minutes left. So, owning too much of your business. If you are the sole owner of your business, you are the only one exposed to capital gains taxation on your exit. So what we're talking about here is the classic estate freeze. You would freeze the value of your company at its current value so that that's your death tax exposure. You may then be able to introduce other key employees or family members into the business as part owners so that you are sharing the future growth of the business and sharing the hopeful capital gains exemption to come down the road. There's lots of flexibility here. Many of you may be young in business and have young families. You may want them to be able to share in the tax burden, but you don't want them to be running the business. So we would often tag this in with family trusts that we would make part of the estate freeze. So the family trust is the owner of those new shares and participates in the growth. So if you're the sole shareholder right now, you're exposing yourself to a lot of tax on exit. Paying too much tax in the growth and exit phase. We talked a little bit about family trusts as a way to get some income out to other family members. I'd encourage all of the business owners in the room that have family in the business to be income splitting with those family members. These are reasonable salaries that you might pay to your children or spouses or other family members for the work that they're doing. This is not paying the children the $100,000 a year salary to sweep the floors every weekend. So we want to be reasonable, but there's nothing wrong with remunerating your family members for the work that they do in your business. You also want to be looking for all sorts of tax credits and tax deductions. Work with your advisors. Take a look at whether there's R&D claims that can be done, other investment tax credits and funding that can be offered. Feeling your company is clean when it might actually be dirty. Here's my prop, a nice clean white napkin because you think your company is very, very clean. But in fact, it's very, very dirty and may not be eligible for the capital gains exemption. So that's what we're getting at here. Is your business eligible for the capital gains exemption on your exit? Do you have the right type of assets in your business? Do you have excess cash that's been accumulating? That is a bad asset. Do you have passive assets that aren't being used in the business? Another bad asset. Do you have goodwill that maybe you haven't measured? The know-how, the knowledge, those are good assets. So this is a very, very difficult test to meet. Being eligible for the capital gains exemption is something that needs to be planned at least 2 to 3 years away from an exit in a business. There's one test that looks at the past 24 months and requires you to have at least 50% good assets. And then at the time of disposition, that test actually moves up to 90% good assets. So I would not be surprised if there's many, and we see this all the time in practice, Giselle, right? Where businesses are getting ready to sell, they've got somebody who's interested, they're at the table negotiating, and they say, well, I'm gonna get the capital gains exemption. I own the shares myself, so I'm gonna be saving at least $200,000 in tax. We take a look at the business structure and see all sorts of bad assets inside that business, and that $200,000 is not saved.
I just wanted to add that I have a client and her name is Mrs. Smith. And that's actually her name. And we had a whole plan ready and she had too much cash in the business, so she was going to put it into a holding company, sell to a key employee. She had a heart attack on her way home from work. And it was $230,000 of tax because she just didn't get that planning done. So
this is a key one, definitely in our small business and family-run businesses. This is something we come across all the time. And the other thing also to keep in mind is the assets that you want to dispose of, are they in the right place? Do you have real estate that's going to stay up in a holding company and you're not disposing of that? You have to be looking at your corporate structure quite regularly and thinking about the things that you do want to dispose of and the things that you don't want to, because trying to reorganize right in anticipation of a sale is generally very difficult and you do not get the same tax savings. Insurance. Do we have enough? Is it in the right spot? Am I paying for insurance out of my after-tax personal funds? Am I paying for insurance out of corporate dollars? Is the insurance policy sitting in the operating company? Well, what happens if I sell the operating company? What's going to happen to that policy? You have to also look at your life insurance requirements as your life changes take place. You may have taken out policies 20 years ago when you were single and your estimated value of your business was X. You're now married, you have 4 kids, they're getting married, you're having grandkids. You may have a totally different need for life insurance and possibly the need for more. There are some rules that are changing January 1st, 2017. So if you do have personally held policies that you can transfer into your corporations so that you're using corporate tax dollars to pay for those policies, you want to have that done before the end of this year. Wills, do we have them? Do we have enough of them? The business owners in the room, if you're comfortable doing so, business owners with one will, Anybody with a show of hands on business owners that have one will that takes care of all of their assets? Business owners that have two wills? Excellent. I see some hands up in the room, which is great. So this is a step, a tool, a trap that many business owners find themselves in, and it has to do with probate fees and the probate application process when you pass away. If you have one will, all of the value of your assets, including the value of your shares of your company, are going to be subject to probate fees at, I think it's 1.5% in Ontario. And if you have two wills, now you have a strategy in which all of the assets that have to go through probate will go through the probate process, but assets that are allowed to be exempt from the probate process, which includes shares of companies and shareholder loans, do not have to be captured through that probate process. So don't put yourself into unnecessary probate fees. Talk to your lawyers, get dual wills. If you're a shareholder of a company, you should have dual wills. Also, business owners that may have foreign vacation property. You may need a separate will to deal just with your foreign vacation property. So that's something that you want to look at as well. And Giselle wants to talk about shareholder agreements.
Just wanted to highlight, I don't know how many of you have a shareholders agreement, but remember, when you pass away, it might be going to your 3 children. So obviously you and your wife don't need a shareholders agreement because you get along, but your 3 kids might need a shareholders agreement. And I just put this on the screen, which you can take home or look at. If you do have one, there should be like 5 things in your shareholders agreement. One is who can own the shares. How do you get rid of a shareholder, or how do you get out as a shareholder? What's the compensation while everybody's working there? And what's the dividend policy? That's your return on investment. And who makes the decisions? What's the government's? Who can sign checks? Who can get the family business into contracts? So a lot of shareholders agreements just have, a shotgun clause. If someone dies, here's what the situation is. They don't talk about if a shareholder owner-manager gets disabled. So you and Johnny are in a business together. He gets disabled. You're doing all the work. What are his shares worth? Now he's not contributing to the family business. So just we are seeing a lot of shareholders agreements not appropriately worded. So I would dust it off, go see your lawyer and update that.
Updating them regularly as your life event changes as well. And I think the last trap is thinking that we have enough time for succession planning. As I mentioned a few slides back, at least 2 to 3 years out, if you're looking at the capital gains exemption, planning for yourself. But something that we're seeing is, think about how many of us in the room, the majority of us that are getting older. I think, Giselle, you said you saw a statistic, 10,000 people a day
are turning 60 in Canada.
60. So if you're thinking of your exit and thinking you have 10, 20 years for that, you may be out of time, and you may be competing with a lot of people who are trying to exit their business at the same time as you.
Okay, some people, so for all the men in the room, I apologize. But I got this from Scotiabank book. Basically, for 100 women, when you're born, there's 110 boy babies born to 100 women. Or 105. By age 60, there's only 95 girls to 100 boys. A lot more drowning, car accidents. So the thought is that young men live a little bit more of a riskier lifestyle than the women. And then it's kind of the same between 40 and 60. But after age 60, you can see the numbers really decline. So when we get to age 80, there's only 60 men to 100 women. So it's more to just say that, these are the facts. I'm hoping all the guys live a long life in here. But there is more of a strategy that men should plan at least 10 years before the women. So I share that.
It's because we're great, Giselle.
Yeah.
Because we're bad news bears, so we plan for all those things, which makes us live a little longer. And I think the last one here, the business owners that are planning to exit. This is, if you look at the graph, in the next 10 years, think about how many businesses are going to be in exit phase. Do you want to be competing with all of those businesses on your exit? Do you want to be a little bit ahead of the curve? This is the classic example of the taxi cab company that wishes they had exited before Uber came into our space versus after.
And the good news is, you're not alone if you haven't have a plan.
That's right. So
yeah.
the choice is yours. You can have the plan for as much of that apple as you possibly can hold on to by fixing your tax traps and planning for succession and not leaving it to the days before exit. Or
You can have half.
you can have a half or a quarter of an apple.
Anyways, thanks, everybody.
Thank you.